silver markets experienced an abrupt and dramatic move in a single trading session, catching the attention of traders and industry watchers around the world. In New York trading, spot silver fell sharply, printing near $74, a move that unfolded quickly and without gradual decline. At the same time, pricing in Asia told a very different story. In Shanghai, silver was trading closer to $82 after briefly moving even higher earlier in the session. The sharp divergence between the two markets immediately drew attention, with many observers pointing to manipulation. However, the article emphasizes that the focus should not be on accusations alone, but on the deeper structural forces now shaping the silver market. According to the report, this price split is not being driven by rumors, social media commentary, or technical chart patterns. Instead, it traces the cause to a specific policy change within the United States. A modification quietly embedded in Executive Order 14,346, including changes contained in an annex, has introduced a legal distinction that affects how silver is treated in international trade. The article states that this change has effectively created a tariff barrier around finished goods, while leaving a tariff-free pathway for certain bullion and raw metal imports. This policy difference, while narrowly defined, is described as having broad implications for supply chains and industrial demand. The article explains that under this framework, finished products face tariffs, while selected raw materials, including certain bullion categories, are exempt. As presented in the report, this creates a clear economic incentive. Companies importing finished goods face higher costs, while those importing raw materials can avoid tariffs if they move manufacturing operations into the United States. The article characterizes tariffs not simply as taxes, but as tools that redirect trade flows. In this context, the bullion exemption functions as an express lane, encouraging the movement of raw silver toward U.S. industry. As described, this policy shift is significant for sectors that rely heavily on silver, including electronics, medical equipment, defense applications, and energy technologies. The article notes that U.S. silver consumption across these industries is substantial, while domestic mining output is not structured to expand rapidly. Mining projects require long timelines for permitting, development, and production. By contrast, the policy change is already in effect, and the resulting increase in industrial demand for raw silver is described as immediate. The article argues that this mismatch between fast-moving demand and slow-moving supply is where market stress can emerge. While the United States has created incentives to draw silver inward, the article reports that China has taken steps that limit silver flowing outward. These measures are described broadly as export controls, licensing requirements, or strategic resource management. Regardless of terminology, the reported outcome is fewer ounces leaving the country, stronger domestic bidding for available supply, and higher local prices. The elevated Shanghai price relative to New York is presented as evidence of this tightening. According to the article, such spreads are not neutral conditions. They normally attract arbitrage activity, where traders buy in lower-priced markets and sell in higher-priced ones. However, arbitrage depends on the ability to physically move metal. When restrictions interfere with movement, price gaps may widen rather than close. The article further explains that this divergence highlights the difference between paper markets and physical markets. Futures prices can decline even as physical availability tightens. The report describes futures markets as operating on leverage, with participants trading on margin. When margin requirements increase, leveraged traders may be forced to sell positions regardless of their outlook. This selling pressure can drive prices lower in a short period. According to the article, such moves do not necessarily reflect changes in underlying demand for physical silver. Instead, they reflect the mechanics of leveraged markets responding to tighter financial conditions. The report states that these forced liquidations tend to affect speculative participants first, while industrial buyers operate on different timelines and priorities. Manufacturers, as described in the article, are focused on securing supply to keep production running, rather than reacting to short-term price signals or technical indicators. As a result, the article suggests that paper price declines can occur simultaneously with strong physical demand, creating misleading signals for those watching charts alone. Stepping back, The article frames the current situation as part of a broader shift in manufacturing strategy. Companies producing items such as solar panels face a choice between absorbing tariffs on imported, finished goods or relocating production to the United States and importing raw materials instead. Silver, according to the report, is not optional in many modern technologies due to its physical properties. While manufacturers may attempt to reduce usage or redesign components, the article states that conductivity limits cannot be eliminated entirely. The first key takeaway presented in the article is that the current silver market dynamics are driven by policy-based demand changes rather than speculative trends. The second is that physical market pricing, particularly in Asia, is signaling tighter conditions even as paper prices fluctuate. As the report makes clear, these forces are developing simultaneously and are reshaping how silver is sourced, priced, and moved across regions. As this story continues, attention now turns to how these opposing pressures evolve, how inventories respond, and whether the growing divide between paper and physical markets narrows or deepens. We will continue with the second half of this detailed breakdown, examining additional market mechanics and the broader implications outlined in the article after this transition. Continuing the breakdown, the article turns to another critical layer shaping the current silver market, and that is the role of currency pressure created by trade policy. Tariffs, as described in the report, act as taxes within the supply chain. When these costs are introduced at the import level, they tend to flow through manufacturing and ultimately reach consumers. This process is identified in the article as cost-driven inflation. It affects a wide range of goods, including appliances, vehicles, construction materials, and any products that rely on imported components. The article emphasizes that this inflationary pressure emerges even without changes in consumer demand, simply due to higher input costs. Ordinarily, central banks attempt to counter inflation by raising interest rates. However, the article outlines a policy conflict. Higher rates can suppress inflation, but they also raise borrowing costs. Manufacturing expansion, particularly the reshoring of production facilities, depends heavily on access to affordable financing. Factories require significant capital investment, and the article describes them as highly sensitive to interest rate increases. If rates rise too aggressively, the very industrial expansion encouraged by tariff policy could be undermined. In this scenario, the article suggests that the burden shifts to the currency itself, reducing purchasing power rather than tightening financial conditions further. In that environment, the tariff exemption for bullion takes on added significance. The article presents this not as a political statement, but as a structural outcome of policy incentives. As costs rise elsewhere in the economy, metals that are not subject to tariffs retain their relative attractiveness. According to the article, this dynamic encourages movement toward assets that are not easily expanded or printed. The bullion carve-out, as described, aligns with this outcome by leaving raw metals outside the tariff structure. The article then examines the relationship between gold and silver through the lens of the gold-silver ratio. Gold is described as reflecting currency stress, while silver occupies a dual role as both a monetary metal and an industrial input. In periods characterized by inflation combined with supply constraints, the article explains that silver historically responds more sharply. In such conditions, the ratio between gold and silver tends to narrow. While the article is careful not to present this as a certainty, it frames the ratio as a useful reference point for understanding market tension. A key factual observation highlighted is that silver prices in parts of Asia remain significantly higher than prices reflected in U.S. paper markets. The article interprets this gap as evidence that futures prices are lagging behind the price required to secure physical delivery. This leads into a critical discussion about market structure. According to the article, industrial buyers differ fundamentally from financial traders. Manufacturers cannot settle production needs with cash equivalents. They require physical material to operate. If contractual claims cannot be fulfilled with actual delivery, confidence in paper instruments weakens. The article explains that this is how stress emerges within paper markets. It is not driven by ideology or sentiment, but by the practical requirement for physical fulfillment. When delivery is demanded and inventories cannot meet that demand, the credibility of the system comes into question. The sharp price decline described earlier in the article is presented as potentially significant in this context. Rather than signaling the end of demand, it may represent a clearing event that removes leveraged participants ahead of stronger physical buying. The report stresses that this dynamic creates psychological pressure. Sudden price drops can prompt fear-driven selling, while larger, quieter buyers step in without public commentary. The article does not advise specific actions, but emphasizes the importance of measurement rather than speculation. It outlines indicators to monitor, including regional price spreads, delivery inventories, and premiums on physical products. According to the article, divergence between falling paper prices and firm physical premiums signals tension rather than weakness. Another important element discussed is timing. The article describes a built-in countdown created by the policy environment. On one side, industrial facilities are being planned, financed, and constructed. On the other, export restrictions and domestic stockpiling are tightening supply. Once manufacturing shifts from planning stages to active procurement, demand becomes immediate and transactional. Purchase orders, as the article notes, clear at prices necessary to secure delivery, regardless of prior benchmarks. The article is explicit that a sustained gap between tariff, protected raw material demand in the United States and higher priced physical markets in Asia is not stable over time. Adjustment is described as inevitable, though the article does not predict the exact path. It states only that heavily leveraged markets tend to reprice abruptly rather than gradually. This is especially relevant where short exposure exists alongside constrained supply. Further, the article highlights logistical consequences of the bullion exemption. Refiners, wholesalers, and vault operators respond to regulatory clarity. With tariffs removed from raw bullion imports, the United States becomes a preferred destination for silver shipments. This reorientation pulls material away from regions that previously supplied Asian demand. Asian buyers, according to the article, respond by bidding higher, securing longer-term contracts, and increasing stockpiles. These actions contribute to the widening price spread observed. The article underscores that the speed of this shift can feel sudden because legal incentives change immediately, while mining supply responds over years. Charts, the article argues, may lag behind reality until physical shortages become visible through delivery failures or inventory disclosures. When such events occur, pricing adjusts rapidly. As the article approaches its conclusion, it addresses skepticism surrounding the narrative. A price drop, it states, does not invalidate underlying conditions, particularly in leveraged markets. The article reiterates three factual points: the sharp decline in paper prices, the higher physical pricing in Shanghai, and the policy-driven divergence between raw inputs and finished goods. Together, these form the basis of the current market structure. Finally, the article notes that public awareness remains limited. Many market participants continue to view U.S. spot prices as definitive. However, when broader attention turns to international physical pricing differences, the conversation shifts from investment theory to availability concerns. At that point, the article suggests demand accelerates from entities focused on securing material rather than timing markets. In closing, the article returns to its central theme: a legal change created a pathway for bullion. Physical markets are signaling strain through higher regional prices. Meanwhile, paper markets continue to reflect leveraged positioning. According to the article, the ultimate question is not sentiment or speculation, but allocation. When demand intensifies, priority flows toward industrial use. The outcome of that process, the article concludes, will determine how silver is priced in the period ahead. That brings us to the end of this report.